Hi, Professor J here, and today we're going to describe what the accounts are in the context of the balance sheet. So, beginning this, we have assets equals liabilities plus stockholders' equity. That's the accounting equation that the balance sheet uses. So to describe assets are things that we have. Now think about it. You have a car, possibly, and you have a loan on that car. But don't you say you have a car? Yes, you do, even though officially the bank probably has a car, you're just using it. Companies act the same way. They say they have their assets. So assets are things the company has. Liabilities are things that the company owes to others, and equity is things that the company owns. So, essentially, if you take everything that you owe plus everything that you own, that's how you've paid for the things that you have. Let me give you an example. Okay, you go out and you buy a car. That's a car. Don't laugh. Okay, so you have a car, and let's say you pay $20,000 for it. It's worth $20,000. You have a car. But what you did to buy that car was you put down $5,000 as a deposit, and you signed a note payable to the financing part of the car place for $15,000. So you owe $15,000. But guess what? Since you paid $5,000 down, you own $5,000 worth of that car. All right, so it's a month later and you have $1,000, so you decide to pay that towards your car loan. Well, does that mean that you suddenly have a car worth $19,000? No. Assets go on the books at historical value. You probably read that in Chapter 1. So the asset stays there at $20,000. However, what you owe went down by $1,000. You now only owe $14,000. And guess what? Yes, you own $6,000 of the car. And the balance sheet equation is still in balance because 20K equals 14K plus 6K just fine. So essentially, everything on the right-hand side of the equal sign is how you paid or what you own of those assets. Liabilities are where you paid someone outside the company, and stockholders' equity is what of those assets you own. You kind of paid with your own money. So everything on the right is how you paid for those assets. That's why they equal. All right, so one step past that, let's talk about what actually belongs in assets, liabilities, and stockholders' equity. I'm going to give you a little hint. So let me change colors here. Let's see, we'll go to blue. I hope that works. Oh, that just changed the background. Anyways, that's fine. So under assets, we have cash. That is something the company has. We also have accounts receivable. My shorthand for accounts receivable is A/R. Accounts receivable are really IOUs. Somebody came in, ran their credit card at your cash register, and walked out with your product. Whatever you were selling, you have an account receivable. So you could also have, for example, a car. You could have equipment. You could have land. Now, a building, if you buy a building, yes, then you would write down building as well. If you rent it, it is not something the company has. You don't own it. It's not yours. So you wouldn't put building there if you were just renting. But if you're buying it, you certainly would. There's one other weird thing under assets I'd like to bring up, and that's what we call prepaids. Prepaids could be prepaid insurance, prepaid rent. Things like that are an asset. I want you to think of prepaids, prepaid insurance, prepaid rent, prepaid anything, as a gift card. When you go to Starbucks and you get a gift card, it's something you have that has value, that gift card. Now you can slowly use it up, but you slowly use up a car as well. You can slowly use up cash. Well, you can slowly use up prepaids because they are gift cards. So if you see prepaid insurance or prepaid anything, it is an asset. Okay, I'm going to draw a line here at the equal sign so we don't get our columns mixed up. Liabilities. Liabilities are anything that says payable after it. You could have note payable, accounts payable, taxes payable, interest payable, wages payable, salaries payable, you name it, you can owe somebody something. And those are all payables. But there is one other thing that fools everybody. It is also a liability. It's a weird one. Like prepaids are weird assets. Unearned revenue is a liability. This tricks everyone. Unearned revenue is money that you collected in advance from somebody. Let's say we're a house painting company and we say we're not painting your house till you pay us up front for the whole job. They pay us $5,000, but we haven't painted squat. Is that money ours? No, because if we never paint anything, we have to give that money back. It is a debt we owe until we earn it, until we do the work. So unearned revenue and payables are about the only kind of thing you're going to find under liabilities, so they're easier. And then stockholders' equity, also called owner's equity, just has two names. Don't worry about it. It's the same thing. Stockholders are the owners. There are 5 key accounts. The 2 that you will see on the balance sheet are common stock and retained earnings. But there are some others. Would you believe that all the income statement accounts, which are revenues and expenses, those are equity accounts as well. Guess what? All the accounts on the statement of retained earnings are equity accounts as well. They are, what would that? Beginning retained earnings. Well, that's already there. Ending retained earnings, that's already there. Net income is revenues minus expenses. So obviously if we add revenues and expenses net to get net income, which is what we do on the income statement, net income is an equity account. And then there's dividends. Those are equity accounts as well. So I hope this helped, and I'll see you in the next video.